All right. Today is Monday, June 24th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Even though I was absent yesterday, got it. But we're back, and that's what really matters. You get your fix today, not last night. What's the big deal here? And nobody's going to get short-handed either. If you happen to be a member in the channel, we're going to give you a bonus video, Charts to Watch, weekly edition. So we're going to look at the weekly charts. We're not going to just say, oh, this looks bullish, this looks bearish. We're going to look at specific trade setups, long, short, and specific numbers for each of these charts. For Discord members, we're giving you options tracker video. We're going to look at the pattern that we call a falling wedge. Recently, we got two trades on them. One was profitable. The other one, we had to cut it because it was taking too long to play out. That one, of course, was Shopify, but we got the profitable one on DraftKings. We're going to look back at these trades, what we can learn from them, so we can trade falling wedges better next time. But folks, we got a really good one for you tonight here for this show. And let's begin with the monologue. Folks, I don't know if you noticed or not, but it is sizzling out there. Hot, hot, hot. In the East Coast over the weekend, the temperature reached the high 90s. And here in the Southwest, we're dealing with triple digits heat. Hot, hot, hot. Matter of fact, they say over 100 million Americans are under heat alert for the first day in the summer. We just started, folks. And if you think that we have any relief coming out soon, you're sadly mistaken. The average temperature outlook for the month of July will be above average for the majority of the country. Matter of fact, now the scientists call it a deadly wet bulb wave. It's not a heat wave, it's not a heat dome anymore. It's a wet bulb. So on top of being hot, it could actually electrocute you. Now, before you freak out and call your kids to come back home before they get electrocuted, A, take it easy. Your kids might take it the wrong way and call child services instead. B, it's a joke. You're not going to get electrocuted if you go outside. These are just a bunch of dorky scientists who give dorky names to phenomenons. Now that they've exhausted heat wave and heat dome, it's a wet bulb all of a sudden. But boy, it is hot, hot, hot out there, folks. How hot is it, Maverick? My left nut now filed a restraining order against my underwear. Too hot, too sticky, and too close. I mean, isn't it enough that I have the right nut next to me all the time? Hopefully my left nut will get an accommodating judge. But, folks, it is hot, hot, hot out there. How hot is it, Maverick? Taylor Swift postponed her tour. You see that? Yeah, I'm not joking. And it's not just because of heat strokes and the crowd fainting all of a sudden. No. She just decided to give the planet a little break from all of that private jet flying. Folks, it is hot, hot, hot out there. How hot is it, Maverick? The scientists are now warning about penguins because, I'm not an emotional guy. I never cry, almost, especially when I'm watching TV. I mean, I watch dead people all the time in the news, and I just take another puff. But when I watch animals dying, I get emotional. I think Investigation ID might feature me in their new program, Signs of a Psychopath. But seriously, folks, I told this story before. I watched the documentary called Dynasties, specifically the penguin episode. And the upsetting thing is the entire species could go extinct if we get one bad breeding season. The whole penguin species, poof, gone. And these penguins are a little sensitive, so if the temperature is a little too hot, all of a sudden they don't breed anymore. With this heat wave, wet bulb, whatever, the scientists are now concerned that we might see the extinction of the penguin species as they boycott the breeding season. But rest assured, there is a solution. Scientists agree that to solve this crisis and the upcoming doom on the penguin species, they suggest sending Elon Musk to the North Pole dressed as a penguin so he can approach the female penguins and ask them, would you like to have my babies? We can name him Kowalski. The only concern the scientists have for this experiment, the penguins might actually get too disgusted and creeped out and off themselves voluntarily. Now, the real bad news about this heat wave, folks, it's going to send your utility bills sky high, hotter than ever before. Speaking of, inflation has been defeated and mission accomplished, the Fed can cut rates now. Yeah, we'll talk about that in a minute, folks. Your electricity bills, or they're going to go higher and higher and higher. But rest assured, the U.S. government now suggests that with this heat wave, this wet bulb, whatever that's going on, there is a way where you can save on your electricity bills. The government now suggests that you set your thermostat at 78. And here's what I got to say about that.
No f***ing way.
But folks, it was an interesting week that was. We got the Juneteenth holiday. Hope everybody got a great week and you celebrated, but not too much though. I mean, look at what happened to Justin Timberlake. He celebrated Juneteenth a little too hard. Instead of exposing a black woman's nipple with no consent, he decided to suck too hard on the nipple of Johnny Walker Black Label bottle. See, the Gen Zers don't even know who Justin Timberlake is. Matter of fact, the cop who arrested him was a Gen Zer. And Timberlake, when he was arrested, he said, "Oh my God, this is going to upset the tour, man." And the cop was, "What tour? What are you talking about here?" And he was like, "I'm Justin. I got a tour. I gotta perform a concert." And the cop was, "You don't look like Justin Bieber. Go back in the car, fool." And only realized who Justin Timberlake is after booking him at the police station. So apparently Justin Timberlake, to the Gen Zers, he's a senior citizen. Matter of fact, demand for tickets for Justin Timberlake's tour here in Las Vegas, so weak. No Gen Zers want to watch Timberlake. They don't even know who he is. So MGM decided to cancel his tour. But rest assured, if you happen to be a resident of Las Vegas and you still want to watch Justin Timberlake, he's still going to perform in this city. But he moved the venue to the Shining Years Senior Retirement Community Center. But folks, we're talking about this mugshot. I mean, look at how clear this mugshot is. And that look, that's a bad look, folks. That's cocaine, that's hookers, that's booze, a little bit of weed, maybe a pack of cigarettes or two. And I always wondered, what's up with these rich people, super rich? His net worth is $250 million. A, can this guy afford a cab or an Uber ride? B, why the hell would you tour at this point? Why the hell would you want to work at this point? You got $250 million in net worth. Help me out here, folks. Why do you think a guy like Justin Timberlake wants to tour the country in senior community centers to make some dough? Did he lose all of his money in drugs and cocaine and all of that? I don't know. Why would Taylor Swift tour the country when she has over $1 billion? I never understood that. If I make a fraction of that, I'll retire right away. You're never going to hear from me again. I mean, the guy just sold a property worth $8 million just recently. What do you need the cash for? But folks, the silver lining for JT, this was good publicity after all. They say no publicity is bad publicity unless you get caught in the Epstein list. But besides that, every publicity is pretty good. All of a sudden, the demand for tickets for JT's tour is skyrocketing. So maybe after all, this whole thing was just a sham, an act. Sort of like the WWE, JT just planned this whole thing to hype his tour and let the Gen Zers know who he is. Because after all, it's all about the tickets, motherfucker, right? JT, I guess he's smarter than all of us. But folks, speaking of the heat wave and bringing sexy back, if you happen to live in New York, I got some good news for you. Because we have New York's Fat Beach Day, which also happens to be the only event in the country that's not sponsored by Ozempic. And speaking of Ozempic and visiting the toilet and all of that, have you seen what happened to Chipotle stock? Last week, and I joked, I said that Chipotle stock got diarrhea because it flushed down in a big way. And this happened right before the 50-to-1 stock split. And nobody can give me a good explanation why the stock of Chipotle got hammered so hard right before the split. The only explanation that I got from Barron's, they say that maybe they got caught reducing the portions in their meals. And now consumers are pissed off. Apparently, they're not just giving you shrinkflation in the stock price, but in the meals too. But still, it didn't make sense to me. Why would the stock flush down that big, that fast right before the split? This excuse about portion size doesn't do it to me. I think I know the real reason. See, Chipotle, I don't know if you know this or not, but on Twitter, they don't own the name, the handle Chipotle. Their handle is actually under Chipotle tweets. Why couldn't they get the handle Chipotle? Because somebody got it before them. Some dude named Chip Clark. This gentleman right here. He owns the handle Chipotle. And Chipotle tried for years. We'll give you $100,000. We'll give you $1 million to give us the handle. And he said, nope, not giving it away. I think he's smarter than JT. And I'll tell you why. Because now I know why the stock flushed down big. Apparently, Chip Clark went loose. He's now tweeting crazy stuff, bad-mouthing the company, racist stuff. Oh yeah, he just gone loose now. I'll give you some samples. He tweeted this recently. He said, I got food poisoning from Chipotle last night. Real N-words eat at Taco Bell. Here's another one for it. It's horrible. It's really, PR disaster. He says, I hear Chipotle reduced portion size. Now my toilet complains about spending less time with him. It's horrible. It's horrible, folks. I mean, if you're Chipotle PR, you got to control this guy. Otherwise, the stock price will go down $10 billion. And rumor has it now, Chipotle will pay Chip Clark $100 million to buy the handle back. Now, one more thing I want to talk about, because a lot of you keep asking me about this. Hey, Mav, what do you think about this monolith that appeared in Las Vegas? A, I live in Las Vegas. I don't own Las Vegas. I don't know everything that goes on in here. B, I don't think it's aliens because, with all of this stupidity that we just talked about in this planet, and we're going to talk about in this program, you really think aliens are intrigued by us? Why? The moment they land here, they eat Chipotle, they get diarrhea, they'll fly away and never come back. But I think that there is an Epstein-y angle to this whole monolith phenomenon. We'll talk about that in another episode, folks. But for now, when we talk about the market, when we talk about the economy, we have an important event, market-moving event coming this week. And that is the presidential debate. You're excited? We got Biden, we got Trump, CNN. But this debate will be different, folks. How different will it be? A, the combined age of the candidates is about 500 years, and CNN got new rules. No audience, no cutting each other, and the candidates must have a bottle of water each because of the heat wave. They should also have a pen and a paper to take notes. And during the debates, the candidates must have their diapers and dentures on at all times. And folks, before moving on, I'd love to pay some tribute to the great actor, legendary actor that we lost last week, Donald Sutherland. Passed away at the age of 88, and it's always sad when they go so young. Guy was a kid at 88. Great actor, rest in peace. But folks, let's segue to the main topic that we got tonight, and we begin with the geopolitics. In the wall of worry, we have many items. Wall of worry for the market, for the economy. Among them, of course, what's going on with the geopolitics. And the reason why we care about geopolitics, the impact on inflation. For example, in the latest CPI that everybody jerked off to, and oh my God, inflation is dead now, the Fed is going to cut rates. Well, the majority of the drop, it wasn't really a drop. Inflation was actually higher, all in all. But it was less than expectations. And the reason is the drop that we got in energy pricing in the month of May was so far, if you look at the chart of crude oil in the month of June, pricing rebounded, made up for all of the losses since the month of May. So the expectations are the next CPI, we will see energy pricing rebounding month on month. And if we don't see other categories going down, then the likelihood is the CPI will come out hotter and will diminish all of the hopes and dreams that the Fed is just going to cut rates because we've achieved victory against inflation. Not going to happen. And the risk now is, what if we see a huge flare-up in energy prices, crude oil prices, right before the elections? Not only it's going to prevent the Fed from cutting rates, even though the economy might weaken a lot between now and then, it could also cost the administration the elections. What do we have right now going on in the geopolitics? We have the Middle East and we have Russia, Ukraine. Let's talk about them one by one. When it comes to the Middle East, I don't know if you saw this video or not, last week, the Lebanese militant group, Hezbollah, released this surveillance video. They've flown a drone over Israel, and they pointed out all of these civilian infrastructure, military infrastructure targets. The message was, hey, Israel, you want to go? Let's go. But this time around, if you hit us, we'll hit all of these targets that you got. And it's going to get really, really ugly. Now, a war between Israel and Gaza is one thing. A war between Israel and Hezbollah is another. And the reason is, it could and it will involve Iran. And if Iran is involved, then we could talk about the closure of the Strait of Hormuz and the blockage of transferring oil. And that could cause a major spike in the pricing of oil and a major spike in inflation right before the elections. This is not a far-fetched proposal, folks, because you see what's going on here. Even the Jerusalem Post, they say a countdown of war between Israel and Hezbollah has begun. The Times magazine say the coming Israel-Hezbollah war. So the drums are here, and you hear Netanyahu, the Israeli prime minister, he wants a war, desperately. And we said this before the whole thing began. This man is in it for himself because the moment he stops the war, the music stops, the man goes to jail. So if he's done with Gaza, he's going to move to Hezbollah. And if it takes fighting Iran, Iraq, Syria, whatever, Russia, it doesn't matter. He'll fight. He'll keep going with these wars as long as it takes. And of course, guess who's paying for them? It ain't Israel. It's us. 30 billion here, 40 billion there, 50 billion there. That's all adding to the deficit. That's all adding to the national debt. And that's all adding to inflation. Now, of course, the wild card is, when do we see? What is the point? Will we see the involvement of the United States militarily in the Middle East? And we're talking boots on the ground. That could happen if we have a war between Israel and Iran. The United States will have to be dragged into it. And that's not a far-fetched idea either, because nobody in this government, Biden or the Congress or senators, none of them adding pressure on Israel or Netanyahu and saying, hey, there is a limit, baby. We'll support you, but we got a limit. If you're going to go crazy with the wars, forget about it. We got our own problems here. We got limited budget, national debt, and that kind of shit. But of course, you know that your beloved politicians are owned and controlled by the highest bidder. And Prime Minister Netanyahu knows that. He knows that he owns all of these tools, all of these clowns that you see in Congress. And he is going to remind them soon that he owns them. Politico says no one knows what he's going to say. The White House fears mount about Bibi's DC visit. So Prime Minister Netanyahu will give a speech to Congress. And if you haven't seen a pimp talking to his horse before, you'll see it live on television. Politico says nobody knows what he's going to say. I know what he's going to say. It got leaked. It's actually a short speech, really short. It has 2 lines. Line number 1, who's your daddy? Line number 2, you need me to bring out my Epstein material? What's the matter with you people? Pass the $50 billion already. Matter of fact, make it $60 billion. And guess what's going to happen? Your beloved politicians will pass the $60 billion. They're actually making it into $100 billion. Because now we got to pay the money laundering, the folks at the Pentagon, the oligarchy. Everybody has to get a cut. And the piggy bank called the United States of America continues to be drained. But somehow that draining doesn't pour down on the population, on the citizens of this country. But folks, this geopolitical problem is not just Israel-Lebanon now. We know what's going on in the Red Sea. And last week, we got a huge attack that sunk a ship. And now we have more and more attacks. Of course, the government pulled back the Eisenhower strike group. I mean, they told us that they were policing the Red Sea. Everything is under control. We're bombing Yemen now. But apparently, they keep hitting commercial ships over and over and over again. What do you think that's going to do to the insurance rates? What do you think that's going to do to the cost of shipping? It is skyrocketing. So now we got oil going higher because of the possibility of Israel-Lebanon war, which will involve Iran. And then you got the shipping problem in the Red Sea. All of this is inflationary. And then you got the third front, which is Russia-Ukraine. That's about to heat up too. Last week, we got Russian President Putin visiting North Korea. And of course, we've seen scenes of bromance with Mr. Putin driving Mr. Kim Jong-un in a new limousine. And he told him, look, Joe Biden is here. If you hit, you get 200 bonus points. And then Kim Jong-un took the wheel and he was driving. And all of a sudden, they signed a pact that if North Korea is hit, Russia is going to interfere to defend North Korea and vice versa. This is a huge change in the world order. You might think that North Korea is too small or Russia is just bluffing, but it's shaping up for a new world war. You see these alliances building up. You got us with some NATO countries and some subordinate countries that have no other choice but to submit because of the dollar and because of the weapons and all of that. Then you got the other world. You got Russia, you got China, you got North Korea, you got Venezuela, you got Iran, you got some South American, Latin American countries. Maybe soon enough, more Middle Eastern countries will join, and we'll see whether BRICS will evolve from a commercial pact to a defense pact. The world is changing, folks, and we're losing. You think we're winning, but we're losing. We're losing the status. And little by little, we're losing the importance of the United States dollar. That's inevitable. Not going to happen today, not going to happen tomorrow. But we're in the path of losing that status. And if these countries, heavy commodities producers, if they sign a pact to trade commodities using a new BRICS currency, that's going to cause massive economic devastation to the United States. And it will cause huge inflation for anybody who trades outside of this BRICS currency. And when we talk about Russia, don't forget what's going on with Russia-Ukraine. Just yesterday, we got an attack on Crimea, and the Russians are now, they're saying it flat out. We blame the United States for the attack, and they say that we're going to pay for the attack. We've seen attacks, Ukraine attacking Russia, Russia attacking Ukraine. The war is now heating up again. And I said it before, and I'll say it again. I think that we will see huge escalation in the Russia-Ukraine war right before the elections. The result of all of what we just talked about right now, folks, is higher inflation, because it's not just the geopolitics alone. We're now getting into a dynamic where we see demand surpassing supply in crude oil, because we've already tapped out the domestic supply here. OPEC Plus has no incentive to increase supply, but demand keeps going higher and higher and higher. And if the Federal Reserve, and I dare the Fed, I dare Mr. Powell, I'm begging you, please cut rates right now and watch what's going to happen. You devalue the dollar by cutting rates, and the price of crude oil will skyrocket, and you will bring that inflation back like JT's bringing sexy back to senior community retirement centers. And now that we talked about inflation and the heat wave and all of that, let's dig down into the macro and talk about inflation and what's happening, because they say inflation is dead, inflation is gone. What are you people upset about? Well, the journal says it's going to cost more to stay cool this summer. Or gee, why? Heat wave? Sure. But it'll cost you more either way. I mean, if you look at the majority of territories in the country, The prices are up year on year for the majority. You got a little bit of a decline, 1.1% in New England. You got a decline of 2.4% year on year in the South, in Texas. But besides that, everybody in the country will see their electricity bills going higher. Or gee, why do we see that? Summer is off to a sizzling start, which means higher electricity bills are on their way. The Energy Information Administration expects the U.S. average monthly residential power bill to rise to $173 in June, July, and August. I wish. Mine was $450. We're not even in the heat of the summer yet. Up 3% from last summer. The government's estimates are subject to weather, of course, but the biggest bumps in electricity. This is really important for you to understand. The biggest bumps in electricity expenses will likely occur along the Pacific Ocean and in New York, New Jersey, and Pennsylvania. New Englanders can expect to receive smaller bills than in 23, according to the EIA. I doubt it. Please, if you happen to be from New England, let me know if your bill's actually going down or not. So should residents in Texas, Oklahoma, Arkansas, and Louisiana, who nonetheless can anticipate another summer of America's biggest power bills, the EIA said. Part of the reason, of course, we see a huge rebound in natural gas pricing. A lot of folks said that nat gas is dead, yada, yada, yada. But the inventories are coming down. Because of the Russia-Ukraine war, we had a surplus in inventories. Everybody hoarded natural gas, and the winter was milder than anticipated. So we ended up with a surplus. But this surplus is being eaten away right now, and soon enough would be in balance between supply and demand, perhaps a shortage. If the heat continues, then we'll have more demand for natural gas, but the supply is lagging behind, which will cause natural gas pricing to go higher and higher and higher, which means you'll pay more and more and more. Isn't this inflation or not? Can you really cut rates when you have all of this going on? I don't think so, Mr. Powell. When we talk about shelter, it's been a sticky part of inflation. And folks been saying, oh, but rent's been going down and just give it a little time. It'll show up in the CPI. Well, it's been over 2 years, never showed up. What we have right now in the rental market is pricing going higher, back up. The median rent been actually consolidating. They say it's about $1,400. Good luck finding a studio apartment for $1,400 if you live in anywhere in the country that has more people than cows. And when we look at home pricing, hitting record highs in the month of May. Furthermore, the journal says that rent hikes are looming, posing threats to inflation fight. Why? Because all of these pandemic restrictions and raising rents, that's going to expire now. Your landlord will increase the rent. There's no doubt about it. Isn't that inflationary or not, Mr. Powell? Then you have, when we talk about condos, part of the reason is insurance costs are moving higher. And this was a really fascinating example to read because it illustrates that insurance premiums, which again you could say, but Mav, the last CPI said that premiums went down. Is it going to stay down? Because we've seen false readings before, number one. Number two, how long will it take for the reduction in premiums to show up? Never mind the fact that a lot of these policies are already signed. Folks will continue to pay these higher premiums, so they're going to have to raise the rents on these condos. Listen to this. Board members of the Highland Park Community Association in Mission Viejo, California, braced last year for a rise in insurance costs. Yet they were shocked to receive a quote for over $170,000, which was more than 4 times what the association paid in 22. 4 times, that's a 300% inflation rate, so they say, oh, inflation is just 3% baloney. Another 12 insurers declined to offer quotes because wildfire risk has made insurers less willing to do business in California. And by the way, it doesn't matter where you are in California. The insurance companies are using this as an excuse to increase premiums across all of California, not just the areas and the zones at risk of wildfire. The new policy provides up to $70.9 million in property coverage to this community of 208 townhomes and condominiums. But in the case of wildfire damage, the maximum coverage would be $2 million, said the board's president. It was like a bombshell, he said. And listen to this, the board raised residents' dues by 20%, the most the association allows per year, to $474 a month. This is not the direction any of us wanted to go, but there is simply no choice. Insurance costs are exploding for condo associations across the U.S., raising the cost of home ownership and making it harder for some owners to sell their units. Isn't that inflationary, Mr. Powell, or not? Isn't that inflationary to the dumb, stupid donkeys who keep saying that inflation has been defeated, or not? And guess who's eating the short end of the stick? It's the Gen Zers, baby. They say millennials had it bad financially, but Gen Z may have it even worse. Why? Because Gen Z is spending more on essentials than any previous generation. Whether we're talking about vehicle insurance, whether we're talking about housing, whether we're talking about food, and their real wages not really catching up with any of those expenses. Not even close. When we talk about inflation and higher rates and credit card delinquencies, guess who's impacted the most? It's the Gen Zers. The change in credit card debt since Q3 of 21. Gen Z, about 43% higher. Millennials, not far behind, 42.5%. So again, the Gen Zers getting screwed the most. Don't ask me about the buy now and pay later data, because that's even more terrifying for the Gen Zers. They're falling further behind in all kind of debt. And believe it or not, we have different inflation rates by generations. They're kind of close, but Gen Z once again experiences the highest inflation rate among all generations in the nation. This home affordability crisis that we see in the country is impacting the Gen Zers more than anybody. When you look at the spending on necessities, sure, they're paying a little more in gas, a little more in car insurance, a little more in dining out. But by far, the largest expense that is derailing the Gen Zers behind is rent. They can't own homes anymore. That's far-fetched right now. Rent is the only choice. And as we see more foreign investors, more domestic investors, more corporate investors like the Amazons, the Bezos and the likes, scooping up apartments, scooping up single-family homes to turn them into rental properties, they're screwing out the Gen Zers because they're paying more and more in rent. And the gap is not even close. When you look at the expense of rent, among all ages, 6.8%. Among the Gen Zers, almost 20% of the budget. And again, I think this is a gross underestimation. I think that for a lot of Gen Zers, you're probably spending more than 50% of your income on rent alone. What are the Gen Zers doing about all of this? Are they revolting? Are they voting differently? Are they demanding for things to change? Because it's been unfair to them? Of course not. This is what the Gen Zers are doing. They're looking into whether chewing gum will enhance your jawline or not. Take a look.
Have you heard of facial gum? It's the latest TikTok trend promising to get you a more defined jawline. All you gotta do is chew the gum. Videos like these show men chewing on gum to see if it'll give them a more chiseled look. And now a handful of companies are actually marketing their products on the platform, claiming that their gum will lead to stronger, more defined jaw muscles. Now the product sells from anywhere from $2 for a pack of 10 to $90 for 6 pieces. Joining us now to discuss this trend is Dr. Tyrone Rodriguez. He is an American Dental Association's consumer advisor spokesperson.
They call it facial gum. You know what else can enhance your jawbones, Gen Zers? How about sucking dick? And maybe you should practice doing that right now. A lot more, because what the oligarchy is planning for you will require a lot of going down on your knees and begging for them to hand out stuff to you. That's the only way you could survive, because the kind of stupidity you're doing right now, we look at the millennials or the Gen Zers. They're investing in GameStop. That's their idea of revolting against the oligarchy, is to empower the oligarchy, is to buy the same scams and the same transfer of wealth that's going on in the stock market right now, in the crypto market. All of this, all of these bubbles that you see right now is a process of transferring the wealth from the public to the oligarchy. And it is the greatest transfer of wealth in the history of mankind. And unfortunately, it is happening voluntarily. Folks are actually cheering for these oligarchs. When you point out the problems with the scam going on in the market right now and the transfer of wealth, you'll be accused of being a perma-bear or a doomer or a gloomer or whatever. You don't understand, it's different now. It's no different. They'll stick it to you even harder this time. That's what's different about it. You want justice? You want the dream of home ownership to be a possibility before you're a corpse? Then you should be demanding for a market crash, for a recession, because that's the only way the pricing will go down. You don't give a shit about the rate of inflation going down. That's not going to help you out. What you need right now is a recession, is a massive shock to the system. What do you give a shit anyways? You don't have a job to lose to begin with. You're too young, you can build up again, but at least you're going to have the opportunity of home ownership. But if the dynamic in this economy keeps going, with the bubbles all over the place and the public keeps pouring more and more and more cash into it, you're going to extend the stagflationary dynamic, which will not make home affordability any better for you. And sure, your investment in cryptos and altcoins and meme shitcoins and the stupid bubbles that you have in the market right now, they'll only make you rich in paper. But if you're not cashing those paper gains as the oligarchs and the CEOs are doing. They're crashing in your head and you'll be left with nothing. And you realize that you just transferred your wealth to the oligarchy. And now when the crash is ongoing and things are getting cheaper, you got no money to buy anything with. And who got the money? All of the money? The oligarchy, the billionaires, the CEOs, and they will scoop all of these assets for pennies on the dollar and cement this massive wealth gap and even make it wider. And with the AI that they're doing right now, they'll replace all of your jobs with AI. And you'll have no other choice but to go down to your knees, not to chew gum, but to suck their dicks to be able to live. But rest assured, there's a silver lining here, folks. Maybe you don't have to go on your knees after all and chew gum and all of that. Maybe there's a hope for the Gen Zers to catch up on the wealth gap and become rich and be able to own homes again. But that hope requires grandma to die and pass the inheritance to you. Because her generation, they got a lot of money with these stock market bubbles. And of course, you paying for their social security and all of that. I'm not saying the boomers are better. The boomers are the most entitled generation in history. They got the cheap homes, the dope music, actual dope, and now you're paying for their social security. And they got this nice stock market bubble so they can retire comfortably while you chase the dream. And now your only hope in life is for grandma to die. Chop chop, grandma. What are you waiting for? You're not going to be casted in the remake of The Golden Girls. Hurry up already and pass the inheritance. Of course, the bad news is grandma is going to pass, but you might get nothing because grandma left the inheritance, all of it, to her kitty cat. And with that, folks, let's segue to cover the stock market now. We begin with the closing of the indices today, and here we go. The diamonds up by 260.88 points or a gain of 0.67%. The Nasdaq, the opposite picture, the laggard of the day, down by 192.55 points or a loss of 1.09%. The Spider, also in the red, down by 16.75 points or a loss of 0.31%. Meanwhile, the Russell 2000 small caps up by 0.87 points or a gain of 0.43%. Now, a lot of folks today have been talking about a rotation. Sell the Nasdaq, buy the IWM. I haven't seen solid evidence of that. I think that the IWM went higher because of gains in some regional banks and some biotech names. I think if there is a rotation, it is stronger in the Dow components. Think healthcare, think defensives, think some of the industrials, the cyclical names, but it's too early to say from 1 day worth of activities. If we look at the daily performances for the sectors, energy back on top, number one by far, followed by utilities, then consumer defensives. The laggard of the day, technology. What do we get from this theme? Technology is risk on. That's the loser of the day. So there is no appetite for risk on, even though the dollar was down, bond yields are down. This is not a good sign for the economy, not a good sign for the market. Furthermore, the defensive/risk off sectors of utilities and consumer defensives are the ones leading. On top of that, energy, the inflation sector, is actually number one. So you have a combination of risk off in utilities and defensives leading the market along with the inflation sector energy. Combination of both. How about a stagflation theme, baby? What about the breadth? Believe it or not, it was actually pretty good. So you see the Nasdaq down, the S&P down, but that's because of Nvidia down 4 or 5%. But the rest of the market did pretty good. The NYSE, 70% advancing versus 28% declining. The Nasdaq, 51% advancing versus 46% declining bout. The problem with the Nasdaq is the 52-week lows. We got 116 new 52-week lows in the Nasdaq, only 38 new 52-week highs. And that's with a positive breadth. Imagine what would happen if we have a negative breadth in the Nasdaq. This remains a huge concern for the market. The breadth remains bad. Even though today, if you look at the heat map, we've improved a little bit. Yes, we have a sell-off in the high momentum names that went way too far. What I called it today in my Discord is we're just trimming the outliers. We have outsized gains that defied the technical boundaries. We're shaving some of those off in where? The AI mania, the chips, and the technology, the big cap technology names, be it in Apple, be it in Amazon. So that's where the majority of the negative impact is showing up. And of course, these names have the biggest weight in the indices, the S&P and the Nasdaq, and this is why we see the indices down. But then you look at the rest of the market. Banks did pretty good. If you look at the cyclical side, a little on the weaker side, but industrials did pretty good. Utilities, you have the high dividend names such as Verizon, such as the consumer staples, whether we're talking about Coca-Cola, whether we're talking about Philip Morris, whether we're talking about Mondelez, all of these classic value, high dividend names managed to outperform today. When we talk about high dividend, but also excellent performers in recession, in stagflation, in inflation, doesn't matter what the environment it is. Healthcare, the big pharmaceutical names. I mean, look at Amgen, Sanofi, all up over 3% apiece today. But of course, the biggest gainer was energy. We talked about this in a previous video. I said, watch out. You got the spot price of crude moving higher, but energy stocks are moving down. And this kind of divergence will be resolved, as we studied in previous examples in that video, will be resolved by energy stocks making a comeback and catching up with the spot price. And we gave you trade ideas for Exxon, options trading ideas for Exxon. They produced massive gains today. You see Exxon up almost 3%. So we see all of these energy stocks catching up with the spot price of crude. And I think they have a lot of catching up to do. The only laggard in energy was the refiners. Valero, MPC, we'll talk about why we see that happening in a minute when we go to the commodities coverage. But let's look at the heat map for the ETFs. Again, TLT up. That means that bond yields are down. We have some response, but not a strong response. You look at the yield-sensitive ETFs. The performers came from the XBI biotech, but again, this is not because yields went down. This is happening because we get rumors that some of these biotech companies are now making advancements in a new Ozempic competitor or whatever. We see these biotech names popping big. You only need a handful of names to pop by 10-20%, and the XBI goes positive. Then we have the KRE regional banks closing positive. My 2 cents, the KRE and the XLF2 got a little oversold in the short run. And again, if there's a rotation out of technology, I think it is showing up in energy, it is showing up in the banks. I'm not seeing it in the IWM though. As a lot of folks on Twitter said today, that we're rotating to the small caps. I'm not seeing that. The IWM was up about 0.5 percentage point, underperforming mid caps and value. Mid caps MDY, VTV, with gains of more than 0.5 percentage point apiece. Now, besides energy, the XLE, XOP, OIH, and even UNG, natural gas, BOIL, they're moving higher today. We continue to see a bid and strength in Chinese equities. The FXI was positive today. A watch out for the EWZ Brazil, because we have unusual trades betting that this stock, this ETF will go higher. It is heavy in commodities, and if we see that oil continues to go higher, some of the soft commodities going higher, it could be good news for the EWZ to move higher from this point on, outside of consolidation that's been going on for a long time. The loser of today's session, of course, the XLK, big caps, the SMH, chips led by NVIDIA, and any risk on coming from Bitcoin ETFs, GBTC, IBT, BITO, all down more than 7% apiece. We'll look at the chart of Bitcoin in a minute, but let's segue to commodities. Today was a positive day for energy. We see the WTI Brent up about 1% apiece. Likewise, we see heating oil, aka diesel, up over 1.25%. And then we have natural gas coming back again with gains of almost 3.75% today. The laggard, though, the gasoline RBOB was flattish for the session. And so long as the gasoline RBOB lags the WTI, you will see the action in the stock market favoring names like Exxon, Chevron, Conoco, Shell, the big oil names, but not so much the refiners, the Valeros, the MPCs, Marathon. Now, if we see the WTI cooling off, then we see the RBOB moving higher and opening a positive gap, then we'll see Valeros, then we'll see the Marathon, the refiners beginning to outperform in energy. If we look at softs, cocoa down big, over 11.5% almost. OJ down a little bit, about 1%, but we see big rebounds here. In coffee, over 5%, lumber, over 1.25%, and sugar. Sugar is important for the EWZ Brazil. That's up almost 3% for the session. Then we look at metals, flattish across the board. I do favor gold over silver, gold over copper right now, but we see a big rebound of palladium, north of 5.5%. Palladium, an important component for chips. If the cost of palladium goes higher, it'll be yet another piece that adds to the evidence that maybe we are reaching a peak in this AI/chip mania bubble. Now, the action was less notable in meats and grains. Those remain weak. So for now, the hottest commodities remain energy and some of the softs that keep coming back, such as coffee and orange juice. Moving on to the big casino, the options market, what do we see here? Of course, the volume right now all migrating toward NVIDIA. The hottest name by far. We've never seen over 6 million, almost 7 million contracts trading in one day for one individual stock. NVIDIA by far the hottest table, the hottest name in the casino right now, overshadowing Apple and Tesla. And the spread between calls and puts still favoring calls, meaning folks still have the bias that these stocks will move higher than lower, and they continue to buy the dips via calls. Here's the problem though. If you look at the IV rank for NVIDIA, for example, it is at about 68%. IV rank means what is the implied volatility right now compares to the implied volatility in about a year timeline. And right now, the implied volatility is higher than, let's say, 68% of days, going back a year. Usually, if you think that the implied volatility is rising as the stock is dropping, we find bottoms when the IV rank becomes excessively high, both on the ways up and the ways down. And if we're at 68 right now, then you can make a case that NVIDIA is not going to find a bid or a bottom until the IV rank goes in the 80s, the 90s, which means we could see more declines in NVIDIA. And if NVIDIA continues to go down, it will drag the indices down too. There is a case of a NVIDIA rebound. We'll talk about it in the charts analysis in the short run, but from a mechanical standpoint, aka volatility, aka options, you can make a strong case that we haven't found the bottom in this recent sell-off in NVIDIA yet. Looking at the bullish to bearish flow, we see bullish in SPY, GLD Gold, EWZ, here it is, Brazil ETF, Boeing, the Qs, Home Depot, Dell, but we see bearish flows for the cash index for the S&P 500, SPX. We see bearish flows for AVGO, Broadcom, MSTR, MicroStrategy, that is a Bitcoin alternative, and SMCI, Supermicrocomputer, another AI mania name, and ABBV, AbbVie. It's been running hot in pharmaceuticals. Maybe we're seeing a migration from AbbVie to Merck to Amgen, the lagging names, Sanofi too. So we'll see what happens in the next few days. But here are some of the unusual activities that I caught for you. On the bullish side, we have the IWM. So folks are saying that we might have a rotation from the big caps to the IWM, perhaps making these bets right now. In this case, somebody bought the 205 calls. The expiration date, August 16th. They paid about $2.5 million for those. So there is still folks in the market now thinking that we might have a rotation from the big caps and the AI mania into small caps. Then we have Amazon. Somebody bought a series of these trades. I'm just showing one of them right now. They're all calls for the 200 strike with the expiration date of September 20th. This trade cost them about $1.5 million, but if you add all of them together, they spent almost $4 million betting that Amazon would be at or above $200 a share come September 20th. We got another bullish one for you, this time around for GLD Gold. Highly unusual. Somebody betting that GLD Gold would be at 225 and above by the expiration date of August 16th. They paid about $2 million for those. So right now, GLD is trading at what, 220? They're betting that we see GLD going higher. Why would gold go higher? Will it be for the good reasons, such as the dollar going down because inflation is coming down? Or will it be for the wrong reasons, such as a defensive formation or seeking refuge in gold? You see some evidence of that today by folks buying utilities and buying consumer defensives, that gold will go higher for the wrong reasons. What about the bearish unusual activities? We have Tesla for you. Somebody bought the 165 puts for the expiration date December 19th, not 24, but 2025. This is a longer expiration date. Somebody's confident that the stock of Tesla will be under 165 all the way until December 2025, which means that Tesla will be under 130 comes that expiration date, at least. The bottom line from this trade, maybe you're not going to follow it because it cost about $8.5 million, and per contract it's about $3,000. But the bottom line here is somebody sees Tesla significantly lower than where it's trading at right now, all the way till 25. They're betting on something bad happening in this company. Then we have the VGK. This is the European ETF, and we talked about this before, the weakness in French equities, the weakness in UK equities, and we've seen some of that in the German equities too. Somebody's betting here that we will see more of where that came from. They bought the 65 puts for the expiration date July 19th. They paid about $750,000 for those. So if you think that European equities will go weaker, this is one trade you can follow. And it will cost you about 50 cents a contract, so it's not really that expensive. Let's segue to the charts and then wrap it up. We begin with the SPY, the S&P 500. Hourly chart, what do we see here? We got an inverse ABC pattern playing out. We got to revisit 544.12. We lost that support line today. Now, can we go all the way to 540.24 tomorrow? That's a possibility. But I would caution against anticipating massive downside in the SPY. We have no evidence of that right now. And I talked about this in Discord in details. A lot of folks want to go aggressive, shorting the SPY right now with both hands. The problem with that kind of thinking is you saw what happened with the breadth. So you got the Nvidias down, you got the AI mania down. That's pulling the SPY down. But the rest of the market, whether we're talking about healthcare, whether we're talking about defensives or utilities, outperforming right now. I don't know how long that's going to last. I don't know how long will the dump in AI last. But for now, without the VIX moving higher, let's say 15 and above, you got no evidence that the SPY will decline in a sustainable fashion. Now, if you get the VIX moving above 15 and we see not only the AI mania going down, but the cyclicals, the healthcare, the small caps, energy stocks, then okay, now we're talking about an inclusive drop that will take the SPY significantly down in a sustainable way. For now, the obvious target that we're looking at for tomorrow's session would be 540.24. And you might look at the chart right now and say, what is that nice yellow trend line that you got there, Maverick? Let's zoom out to the daily chart, and here it is. It is a daily trend line that goes all the way back since the recovery, the bottom that we got in or around the month of May. And again, suppose that we go down all the way to the trend line. That'll give you a decline of about, let's say, 1.5%-ish. And that would not be a big, steep decline or a correction. We haven't had a 2% correction in a long time. So keep your expectations tame for this correction right now until we get and gather more evidence, until we get support lines broken in the big caps, in NVIDIA, in the AI mania names, until we get a trend line like this on the daily chart for the SPY broken, then we can be more aggressive. Because right now, if you look at the hourly chart for the E-mini futures, for the S&P, what do we see? We see consolidation. Maybe we're forming a bear flag that will lead us to more declines to come. But we are still above the bull to bear advantage line that is standing at 5,454.5. We're still trading above. We need to see more damage before you get more aggressive and you see an inclusive sell-off in the S&P. That will happen once the VIX goes above 15. Once we see the E-mini futures trading below 5,454.5. What about the Q's hourly chart? What do we see here? It is similar to the SPY. We got a little overheated, a little too crazy, and now we're just shaving off the overshoots. That's it for now. We got support at 473. Since we're trading at all-time highs, we don't have a lot of points of reference where we can identify support and resistance. So we'll stick to 473 right now. If that's broken, we go down to the gap at 468. Now we're going to look at this yellow trend line and say, what is that nice trend line you got going over there, Maverick? Here it is. We zoom out to the daily chart. What do we see here? It is the daily trend line that goes all the way back since the last bottom in or around the later part of April, the early part of May. Even if we do a full revisit to this trend line, it's going to be a downside of about 2.5%, nothing more. At least for now. You break that trend line, then we're talking about more declines to come. But for now, one step at a time, 473, if that's gone, 468, if that's gone, then we can talk about the trend line. If we look at the NASDAQ futures hourly chart, what do we see here? We are below the bull advantage line, 19,950. But we are not below the bear advantage line, meaning the bears are not in advantage yet. See, the S&P, the ES, E-mini futures, the bull-bear advantage line is the same number. Here, if you trade above 19,950, bulls got the advantage. If you're trading below 19,612.25, the bears got the advantage. For now, we're neutral. We're pulling away from bullish, but not quite bearish yet. We need to see more damage. What about the small caps, the IWM? We'll look at the hourly chart. What do we see here? A lot of folks talking about a rotation, but I don't see it strongly here. I would say if we have a closing above 202.5, we will cut because we have a bearish trade in the IWM right now. And we'll cut that because in that case, if that happens with the close above 202.5, then we have a series of higher lows. If we continue to fail at 202.5, we go down closing below 201. We want to double down on the bearish trade against the IWM. And the reason is we can look at it as a larger bear flag pattern. Matter of fact, if you look at the daily chart today, we got a nice rejection at the 20 days moving average in white, which was in or around 202.5, but we lost the 50 days moving average in blue, which again gives you an attempt for a rebound that was met with failure today. The confirmation of thereof would be a loss of 201. That will mean a confirmation for the bearish trade, and therefore we double down. How about the dollar? What do we see here in the Dixie? A little bit of a bearish engulfing candle, sure. Does it mean that the Dixie is now negative? No, it is still positive. But again, folks, let's brainstorm some events that we have this week. On Friday, we got the PCE inflation rate. That is a lagging piece of data from the month of May. The likelihood is it's going to be tame, cool, and the result would be the dollar going down. The problem that we have right now is with the ECB cutting rates, with the Swiss bank cutting rates, and rumor has it that we will see the Canadian bank soon enough cutting rates. All of these rate cuts by foreign banks are devaluing those currencies. And in effect, we see the dollar moving higher because of that alone. So yes, you have the impact of, okay, softer PCE would drop the dollar down, and that could be good for equities. But what about the devaluation of other currencies? That's going to keep the dollar higher. So for now, relatively, my 2 cents, I think that the dollar is going to stick, and part of the reason the dollar knows that the PCE will be tame. What about the CPI though? That's more relevant, and it comes out in about 2 weeks or so. And if energy pricing continues to trade where it is right now or higher, then we will see a hotter CPI. And I think the dollar will look forward to that rather than the PCE. Just my 2 cents for now. What about the old man gold? Believe it or not, with the dollar going higher or lower, we've seen a formation of a bear flag pattern after a bearish engulfing candle, a big one in gold, but it didn't play out. Now we got another big bearish engulfing candle on Friday's session. And we're forming what it appears to be a bear flag pattern. My 2 cents though, with the dollar going up or down, I think because of the stagflation dynamic, we see a lot of demand for gold, and I think that gold will become positive again. Look at the MACD indicator. Despite the consolidation right now, which is a process of gathering energy, if the consolidation doesn't lead to a breakdown in gold and we keep consolidating here, then what the chart of gold is saying, look, I want to release all of this energy to the upside. Dollar or no dollar, there is demand because we have a defensive bid, not just from investors or hedge funds, but also from central banks who are now loading up on gold more than ever before. What about the GDX? Gold miners, not my favorite to play any upside in gold. For now, it is struggling underneath the 20 days moving average in white. If we plug in the 50 in blue, it's still below. Sure, it might go higher because of gold pricing, the spot price going higher, but I'd rather be in the GLD over the GDX. And the reason is if we have a rise in gold and oil at the same time, the miners have an expense. They have to transfer a lot of the stuff that comes out of gold mines, waste and product alike. And that's going to cost them more with higher energy costs. So I'd rather be in the spot price and the commodity price, and the GLD tracks that better than GDX. I also rather be in the GLD over the SLV. For now, we look at silver. It is below the 20 days moving average. I don't think it's done going to the downside. I think it might have a revisit to the 50 in blue, perhaps the lower Bollinger Bands, in or around 26. And you look at the MACD indicator on the daily, it is not showing the same positive formation that we see in gold yet. It might happen in time, but once again, for me at least, GLD over SLV. What about oil? UK oil, daily chart for Brent. What do we see here? It was a positive day, but not as positive as we see in US oil. That's the WTI. So the majority of the gains that you've seen, the big gains, I should say, that we've seen in ExxonMobil and Shell and Chevron today, happening because the WTI managed to outperform. Sure, Brent was up about 1%, but the WTI outperformed by a lot. For now, we see a bull flag pattern. The next resistance I got is in or around 83. If we look at the XLE energy stocks, we talked about this before. The falling wedge pattern, here it is again. We got a breakout. We're above the 20 days moving average. I think we have more gains to come. We should finish all the way to the 50 days moving average in blue or the upper Bollinger Bands, let's say in or around 92.5. Of course, the heaviest component in the XLE is ExxonMobil. We see a huge breakout today above the 20 days moving average. You see the RSI improving. You see the MACD improving from bearish to bullish. The first time since April. I think we have more gains to come in Exxon and the energy sector right now. This breakout, you need to be in it. It is a lot better than buying the dip in the AI mania, at least for now. Looking at the 10-year yield, what do we see here? Still consolidation in a bear flag pattern. It could turn positive, but again, 2 cents. The PCE will probably be tame. And if it is, it should drop yields down. We have to wait till Friday. But for now, are we seeing any positive response to the consolidation in the 10-year yield or the possibility of it dropping down when the PCE comes out? We're not seeing it right now in the XHB home builders. Sure, a positive session, but it is not reversing anything here. If you look at the weekly chart for the XHB, it is still below the 20 weeks moving average in white. So it remains negative. If you want to chase any yield proxy, meaning yields go down and the ETF goes higher, you got a better play in the IYR. It actually did break out today. It reached the upper Bollinger Band, then came back down. You might look at that as lack of progress, but the progress that the chart has done, in the daily chart at least, is erasing the possibility of a bear flag pattern and erasing the possibility of a topping head and shoulder pattern. With that being said, we're closer to the upper Bollinger Bands on the daily chart, so we know that the gains will be limited. If I'm chasing any yield-sensitive ETF right now, I think it's going to be the KRE regional banks, because IYR might top in or around 88.27, the upper Bollinger Bands, and face a lot of resistance there. But if you look at the KRE regional banks, you got a bull flag pattern breaking out above 47 right now, a touch above the 20 days moving average. But we still got the 50. We still got the upper Bollinger Bands all the way at about 49. So I'd rather, if I want to chase, I'm not saying that I'm chasing right now, but if I want to chase, I'd go with the KRE over XHB and over the IYR. What about the VIX, the volatility index hourly chart? What do we see here? You can see the tension in or around 1324. We tried over and over and over again, and I said that we're forming a cup and handle pattern. But we're going to break above this resistance, making it to support sooner than later. We've done that already. Today we got a gap and cramp of some sort, but we haven't lost 13.24 support. If that continues, and if the VIX continues to move higher from this point on, maintaining 1324 support, then sure, we will begin to see a process of an inclusive correction in the S&P 500, where we're not going to have a lot of spots to hide. Maybe energy, maybe gold, maybe here and there utilities, but you're going to see an inclusive sell-off, AI, big cap technology, cyclical, industrials, defensives alike. But the key to that happening is the VIX maintaining 13.24. And if it does, then we are forming a higher low pattern, which will lead to a breakout. Big Kahuna Apple hourly chart, what do we see here? Last week, we talked about a bear flag pattern. Didn't play out right away. We actually got a pop Monday, but it formed another negative pattern of a double top. It went down, played out the bear flag anyways. A loss to 1181. Today we got another pop, attempt for a recovery, but we closed short of 21181, meaning there's a seller sitting at that number. Every time we go above, the seller presses the button, meaning that we need to go down to find support. And in this case, we can go down, let's say, to 205.92, 206. A lot of folks looking at the 207.5, which is the options strike price, where we could see some demand. But the hourly chart honestly doesn't offer any clear vision that we're going to see one outcome versus the other. All we see is we're stuck within range. Sure, we are below 211.81, which supports the pullback at least all the way to 207.5, 205, 206. But we have to look at the daily chart to gather more evidence. When we do that, look at the MACD indicator on the daily chart. It's been begging for a correction, but every time we're close to one, we see the mysterious save. As if somebody says, okay, we're about to see weakness in NVIDIA, let's pump Apple, because we have the $250 billion pump that we see every day that NVIDIA was capturing. Let's rotate some of that to Apple. We keep the indices afloat. NVIDIA goes down, but Apple goes up by 3%, 4%, and they balance things out. But right now, we got a little too excessive, and the MACD suggests that we're going to see the correction sooner than later. Suppose we get one. Where can we find support? The answer is the 20 days moving average in white. That's in or around, let's say, 201. You don't want to be too aggressive in betting on a pullback in Apple, because what you could see is this, pulling back to the 20, then forming an ABC breakout. And this is why I've been saying on Discord and otherwise that if you're going to play a pullback in Apple, make it into a 5 points increment. Meaning using put debit spreads with a 5-point increment. You buy the 210, you sell the 205. If we go down to 205, you buy the 205, you sell the 200. But you don't want to be more aggressive than that, such as buying the 195 puts or the 200 puts right now, because we have no clear evidence that we have capitulation or a give up in Apple right now. If anything, today's action was supportive for folks looking to buy the dip. They failed today, but they're still here, and you cannot dismiss them right away. You need to scare them a little more for them to go away. What about the souffle Tesla hourly chart? What do we see here? We're above 180, which is the bullish advantage line, so the bulls are still in charge, but we are in a tension pattern. You can see the higher lows and lower highs, and we haven't broken one way or the other. There was an attempt today of a break to the upside, but it didn't happen. So unless we have a break one way or the other, even if we have a break to the downside, by the way, you're not going to short Tesla until we break below 180. Then you got to trade to the downside. So for now, the bulls got the advantage, but you'd love to see a break to the upside in this consolidation pattern. What about NVIDIA? We gave you the guidelines in the morning brief today, so if we trade above 127.16, we got a full recovery. You want to buy NVIDIA at that point. If we trade above 124.30, not enough, but it is resistance for now. We got support at 120.91. We got there, couldn't find support. It became resistance, and the chart couldn't make it above it. So the next support becomes 117. Suppose we open gapping down to 117 tomorrow. I think the hourly chart will become really oversold. We will see a bid to rebound NVIDIA from that point on. How long will it last? Here's the problem though. You look at the daily chart. We do have significant damage because we've lost the 20 days moving average. So if you get a rebound of 117 without closing above the 20 days moving average, it's just a rebound because the hourly chart got oversold. That's all there is. But the downside momentum is intact. And if that is the case, let's use Fibonacci's numbers, forget about the Maverick numbers. And we can find that the next support would be 115.87, which is close enough to 117 if you want to be conservative. Take Fibonacci's number, 115.87. But boy, the momentum is on your side, betting for a pullback. You look at the MACD in the daily chart, it is turning negative, got way overheated. I don't think that we're done with the corrective process. We might get oversold in the hourly, get a rebound, but we're not done with this correction Because you see, the insiders like CEO Jensen Huang is actually dumping a significant portion of shares, and that's going to add pressure until he's done. Maybe he's going to be done tomorrow, or maybe by the end of the week. When he's done, we might see a stronger case for a rebound than just a technically oversold RSI on the hourly chart. Now, if you look at the SMH, it is still breaking down. I think we have more losses to come, but we got to the 20 days moving average. Now, if you're trading options, folks, you cannot afford to be greedy when you have shorter expiration dates. You cannot be greedy if you're betting on counter trend. So right now, despite the pullback that we see in NVIDIA and SMH, the trend remains positive. So today we closed the SMH puts that we got a nice profit on it. Folks called me a pussy, but I'm going to be disciplined here, folks. If I see more damage in NVIDIA, I'll be back in the SMH again. I'll be back in NVIDIA puts again, but I'm going to buy longer expiration dates. I'm going to buy different strike prices. You can always get back in the trade, but you cannot recoup your gains once lost. And if you're a counter trend trader, as we've done in the SMH and in NVIDIA, you gotta be in the process of collecting your profits quickly until you have clear evidence that the bullish trend has been broken for good. And lastly, tulips, Bitcoin, what do we see here? You know, over the weekend, the scammers on X/Twitter came out and said, oh, there's the liquidity is now about to increase by the Fed, which means good news for Bitcoin. They always come out, the scammers and the bots, always come out when Bitcoin is about to flush down. We got a nice flush today. The question becomes, was it a climactic flush? Meaning high volume, big candle to the downside, scaring a lot of folks out, which marks a bottom. I think we have some of that today, but I don't think we're quite there yet. I'd love to see 56,500. If we hit there, I think that would make a more of a solid rebound than any rebound we get right now. That will be short-lived. The concern for Bitcoin, of course, if we switch to the weekly chart, are we about to see a maverick top here? And if we do, the next support would be at the high 30,000s, low 40,000s. So it could be a steep and a big flush down in a short amount of time. So folks, if you have any Bitcoin gains, you got to think about de-risking strategies right now, hedging strategies. You can always get back in the trade, but you cannot recoup your gains once they're lost. So think about some hedging strategies just in case the scenario I'm showing you right now plays out. Hedging strategies meaning booking profits, buying an inverse ETF for Bitcoin, buying puts on a bullish ETF for Bitcoin. You have many different avenues on how you can hedge your Bitcoin holdings. But just going naked and watching a correction happening is a fool's errand. With that, folks, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Tuesday, the 25th. We have a bunch of Fed zombies speaking with Governor Bowman, then we have Lisa Cook. But the most important piece of macro data we're getting is the S&P Case-Shiller Home Price Index and the final reading of consumer confidence, which was not good in the preliminary reading. If we move on to Wednesday, 26th, we have only new home sales, so a slower day, perhaps more dependent on the technicals and the mechanics, rather than the fundamentals or the macro. But Tuesday, 27th, we heat up a little bit again in macro. We have initial jobless claims that comes on top of the GDP, durable goods, and pending home sales. And lastly, Friday, the 28th, the most important day macro-wise, we get the PCE report lagging but still impactful. And then we have Chicago Business Barometer and the final reading of consumer sentiment from the University of Michigan. So we have two readings of consumer sentiment. One comes from the Fed, the other one comes from UMich. So this one will be from the University of Michigan, which has more impact on the algorithms than the Fed's reading. And of course, comes Friday, we have more Fed zombies, this time around from Richmond, Thomas Barkin again, and Governor Bowman. With that, folks, hope you enjoyed the show. If you did, return the favor by pressing the like button, subscribing, and consider being a member to catch up on our daily videos and bonus videos. You can join us here on YouTube as a member or on Patreon. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Just going to do the bottom three lines, FLEPT, PLEPFL, FLEPT, PLFET. Do you think oysters would be too much for the first date?
You have 20/10 vision, Captain.
Yeah, these are just for looking at you, kid. I may be blind, Frank, but my memory is perfect. FLEPT, PLEPFL.